this information back then. And you didn't have, right? You didn't have supply demand strategy or anything like that. So, as I saw and really dove into the actions of both groups, I also saw that the novice trader, and the professional trader, the way they make decisions is really opposite. One group focuses on what they feel. The other group makes decisions based on what's real. For example, if some bad news comes out on a big stock, right, and or a couple stocks or what have you, and the Nifty gaps down because you have this big group of people that heard the news, they think bad news, market must go down, I'm going to sell. Happens all the time, right? So now that group is selling. That brings price down to typically one of our demand zones where demand exceeds supply, where financial institutions, banks are buying. And then that last news-driven seller sells at a price level where demand exceeds supply, price typically goes higher, right? Again, if you focused on what you feel to make that buy and sell decision, you were the seller. If you focused on what's real, price was at a demand zone, price was at wholesale levels, right? That's what's real. So you're the buyer. So, I saw all that in the beginning, and that's really what I kind of mapped out on price charts. Today, we're going to go over quite a bit of that so you can see what that looks like. But more importantly, so you can understand why, when you see price moving, it's very important to understand why it's moving. You'll have so much more confidence when you can understand why things are happening, right? Again, it's one thing to just have rules, and we're going to go over that. But it's a whole nother thing to really own that knowledge, own that skill set. So I want to make sure, you understand all of that. Price, there's nothing random about any of this. It's all a numbers game. We'll see that in a minute. Everything we talk about, the goal is to have this razor sharp focus on just making sure that all of the evidence we're gathering in the market with the price charts and all that, everything we're focused on is to answer two questions. Where will price turn in a market? And where will price move in a market? If you think about it, and we don't need to look at a chart yet to see this, if you think about price turning in a market, again, I saw this on the trade desk, right? I had the orders. Price would fall, and once it reached a price level where we had a big stack of buy orders, which means there was a significant supply-demand imbalance, it would stop falling and turn higher. It would keep moving higher until it reached a price level where we had a big stack of sell orders, right? Another way to say that, a significant supply-demand imbalance on the supply side, right? So that's where prices turn in a market. Once prices turn, where will they move to? Well, if a significant supply-demand imbalance causes price to turn, the lack of a significant supply-demand imbalance facilitates price movement, right? Now, as we went over last time, this is typically what supply and demand would look like at a certain price point, right? Sometimes it'd be close to equal, but it would never be equal. Here, at this price, if we have this much on the buy side, this much on the sell side, remember, as soon as all of these sell orders are filled against these buy orders at that price point, you're going to have a lot of demand left over, zero supply, price has to go up. That's what happens when the equation looks like that, right? The greater this imbalance here, the higher the probability price is going to turn. There are a number of things we can look at on the price chart that will help us determine the level of supply-demand imbalance. Make sense? But it all comes down to these two competing forces, supply and demand, buyers and sellers. All right? Now, I know what we're talking about here is, again, fairly basic. We went over some of this last time, but it's so important that you understand the logic and understand the order flow that's going on behind the scenes that's responsible for the creation of the candles or bars or whatever that you see on the price chart, right? There's a reason for all of it. Okay, it's very important. So right here, let's start with governing dynamics. And again, we'll move through this part kind of quickly because we talked about it for a while last time. How markets work, right? Now, we're talking about trading markets. Whether you're a day trader, swing trader, longer-term investor, it's all the same conversation. It's all the same logic. It's all the same rules. And we can apply any of this to any market out there. It doesn't just have to be financial markets. If we're talking about the market for the food that you buy at the market, or the appliances you buy, right? The television set, a car, a home, it's still the same conversation. How and why price moves as it does is always the same. It's all about supply, demand, and fair value. Right? We're going to focus on this fair value first because this is where price spends most of its time. This is also where we really want to be able to identify fair value on a price chart because we don't want to enter positions here. This is the biggest reason people lose money. One of the biggest. There's two big ones. This is one of them because people buy and sell in the middle. Fair value. Fair value represents where the majority of buyers and sellers agree to buy and sell. So if you think about your favorite food that you buy at the store, right, that you buy at the market, well, we would all like to buy that cheaper than they're selling it for, but that wouldn't work because the store wouldn't make any money, and the market would, the shop wouldn't make any money, and they'd have to close. They would also love to sell that food for a higher price than we're paying, but that wouldn't work either because we wouldn't, too few people would buy, and the shop would shut down again, right? So we all agree, or I shouldn't say all, the majority of buyers and sellers agree to buy somewhere in the middle, somewhere where the market, right, the store makes enough money and it's still cheap enough for the majority of people to buy. That's how supply and demand regulates price if you just leave everything alone, right? Make sense? So because fair value is where the majority of buyers and sellers agree to buy and sell, fair value is actually the magnet that pulls price back to it. Okay, when price gets away from fair value, typically it comes right back. And you could think, again, just think of any market, think of any product out there, right? Same thing in the trading markets. Now, prices go, fair value changes. Think about all the food that you buy at the store. The price of it isn't always the same, right? Something that we all may have paid a certain price for a few years ago is maybe now maybe fair value is now higher, right? For most people, it is right now. Sometimes price moves higher based on some news or there's not, less of that product is being developed or what have you. Same thing in the markets. So price reaches a level where supply exceeds demand. Remember, competition to sell at supply, which is what it is, pushes price lower. Right? And just like the example we looked at a moment ago, sometimes price comes down to a level where demand greatly exceeds supply. Competition to buy at demand pushes price higher. And all the while, fair value is pulling it back to it. Okay? This whole supply, demand, fair value can shift higher, shifts lower, stays the same sometimes, right? But this is how prices move in markets. What's most important for us is, what does this picture look like on a price chart? We went over this last time too, so I'll be a little bit quicker here, but there are two characteristics that represent fair value. One is, look at the majority of trading, right? Where's the majority of trading? That recent and relevant area where we have the majority of trading in a market. We'll look at that more in a few moments. And two, notice the wide and whippy price action here. Why is that important? Because if price is going up and down so easily here, that can only happen because there's a lack of a significant supply-demand imbalance. In other words, there can't be a big stack of unfilled buy or sell orders in the middle. If there was, the picture wouldn't look like this. You'd have very little trading. Price would move away from that area and not come back, right? Also, look at this little area here in the middle. See this thing? For those of you that are familiar with supply and demand, notice rally, base, rally. One of the picture that represents demand. Notice when price comes back to it, it goes right through that level. Doesn't work. Well, the majority of these won't work because they're in the middle. There was a supply-demand imbalance when price went up here, right? Make sure you understand price goes up here because demand exceeds supply in this area. However, it doesn't mean there's a big enough imbalance to where we want to buy when price comes back here, right? And I'm only speaking at this level this early in our session because I know this is meant to be more of an advanced session. So the assumption here is that most of you are familiar with the strategy already, okay? So we'll take things a little bit deeper, right? We don't want to buy and sell in the middle. We want to buy and sell when we can predict where prices are going to turn with a high degree of accuracy. We can't do that in the middle because we don't have a big imbalance. Everybody understand that? Those large imbalances are outside of fair value. Okay? All right. And then, right, so what we do is we then apply our structure and location rules. And we went over this last time, so we don't need to dive into all that here. We spent most of our time on structure and location last session. And we find our qualified supply-demand zones, right, above fair value and below fair value. Remember, the two pillars that drive everything we do when it comes to rules are structure and location. There are four things that have to be present in a supply-demand zone for it to qualify as far as structure. And then it just comes down to location. Is it inside of fair value or outside of fair value? That's it. Okay? All right. We focus on entering positions out at supply and out at demand outside of fair value because the probability of price turning is highest. And the profit zones, right, risk reward, are ideal. In the middle, neither of those are true. Okay, let's keep going. So if we take a look here, we have our two demand zones on top of each other, two price levels here where the chart is suggesting demand greatly exceeds supply. I'll go a little deeper on the basics on this one, and then for the going forward, we won't spend much time on the basics because again we did that last time. But notice price is trading sideways here for a very short period of time, right? So short that you barely see any trading here, and then it moves higher out of this area, out of that price level. Understand the only reason that happens is because demand exceeds supply here. There's a big supply-demand imbalance. When it comes to the structure of these two zones, okay, they meet the four criteria for structure. Then when it comes to the location of these two demand zones, notice when price comes back to the zone over here, where is fair value? Where is the majority of trading activity? Where is that wide and whippy trading activity? It's all up here. Okay. Down here, when price gets here, competition to buy at demand, which is what this is, pushes price higher. Fair value, which is where the majority agree to buy and sell, is that natural magnet that pulls price back to it. Does that make sense? Okay. Try not to overthink it. Try to keep it nice and simple. All right. Now, why does price come down here, first of all? Why would price come down here? Well, what happens is, I kind of mentioned this earlier, price is trading sideways here, and all of a sudden there's some bad news event, right? And at that moment, when the bad news comes out, buyers and sellers in a market have three choices, right? they can either do nothing, or they can sell, right? Or they can buy. Now, if we focus on the sellers, they're hearing this news, they're making a decision to sell based on what they feel, right? Because you would only want to buy in a market if prices were at wholesale levels where demand exceeds supply, and certainly that's not the case up here. There's no evidence telling us that. So so the group that comes in and sells based on what they feel, they just sell. That drives price lower. Why? Because there's not enough buy orders up here to fill all those sell orders or supply coming into the market. The price level where there's enough buy orders to fill all that new supply coming into the market is right here, right? The demand zone tells us that, right? The demand zone suggests that. Does that make sense? Remember, the definition of a qualified demand zone for us is a price level where there's a big supply-demand imbalance on the buy side, meaning a big stack of unfilled buy orders. That's what that represents. So down here, all of those orders again more of those orders are being filled. Finally, the last news-driven seller sells at a price level where the chart already suggested demand greatly exceeds supply, right? So the number of sellers goes to 0. On the buy side, there's still a lot of demand here. Again, that competition to buy now pushes price higher quickly. And price ends up right at fair value. That's how prices move in markets. That's why prices move and turn in markets. Okay?
Sim, I have a question here.
Yep.
So you're saying fair value is the place where generally the stock will keep trading, or the stock or the index will keep trading. It's at the demand zone and at the supply zone where the most of the buying and most of the selling will happen by the institutions, right?
Not most of the buying and selling.
But the
demand and supply is there.
Yeah.
Right.
So fair value will be somewhere in the middle of demand and supply.
Correct. Always. Yes. Always. Now, down here at demand, though, whoever's buying here, did they get to buy all that they wanted to buy? Were all the buy orders filled? Right. The answer is likely no, because if supply and demand was equal here, wouldn't price just keep trading sideways? It would, but it couldn't. It stayed here for a very short period of time, which is one of our key things for structure, and it took off. Okay. And when I was on the trading floor, I experienced that all the time. When we would have a big order to fill, let's say it's on the buy side, right? Some big financial institution, we'd have a huge buy order to fill at a certain price. Well, our biggest problem was there weren't enough sell orders at that price. There wasn't enough supply at that price. So we'd have a challenge filling that order, right? Every time price would come down and we'd fill some, you'd run out of sellers at that price level. So price would keep moving higher. Does that make sense? Okay. So another way to say all this, right? Back to the two groups, the novice traders and the professionals. Novice market speculators, day traders, swing traders, investors, typically make two mistakes when they buy and sell. And we'll mention that here. If we focus on the sellers here, right, we know these are those novice market speculators making those two mistakes. Mistake number one they're selling after a big drop in price. Think about it. You would never do that anywhere else in life and be, consistently profitable doing that, right? You would never do that. Next, and worse, mistake number two is worse. Not only are they selling after a drop in price, they're selling right into a price level where the chart is already suggesting that banks and financial institutions, the smart money, is buying. Make sense? And down here is where it happens, that transfer of accounts from people who don't know what they're doing into the accounts of those who do. That's how it works. And I know it seems crazy to think that people are selling down here, but they do.
They do.
And I want to emphasize this point because we don't, everyone in our session today, yes, of course, we want everybody to make money, but we also want people to stop losing money, right? And down here, the news is so strong. The urge, the emotional urge to sell is so strong, right? You have to fight that. And you have to really focus on, say, wait a second, if I'm buying and selling anything in life, what should I be doing now? And your answer is prices are at wholesale levels. At wholesale levels or demand or a buyer. Now, you have to make sure the risk and reward is okay, right? But in this case, obviously, it's fine. And we'll go over buy and sell rules in just a bit too. But again, and when I was working, when I was, on the trading floor and developing the strategy, for me, the focus was to get in as close to the turn in price as possible, because that's the only way to attain the true low risk, high reward, and high probability entry into a market. So, that's why we focused on supply demand. That's why I developed the zones, not just one line of like support resistance, to make it, realistic, like attainable. All right, let's keep going. Here's the same thing, just the opposite on the sell side. We're looking at an example of the Nifty. By the way, what you're looking at here on the screenshot on the left, right? So these are our live trading sessions, live trading and analysis sessions. And these are where our members are here, just so you know what you're looking at. So here we had a supply zone in the Nifty, and then fair value down in here, okay? Notice price is just trading in this range right here for a while. All of a sudden, something happens that brings in some new demand, some buy orders. Price rallies up and then gaps up. Okay, gaps right up into our qualified supply zone. And remember, a qualified supply or demand zone has to meet the criteria for structure, has to meet the criteria for location. And this one does. Okay, up here, someone is buying after a rally in price. Mistake number one. They're buying right into a price level where the chart already told us supply exceeds demand. Mistake number two. All right, and then again, that competition to sell just pushes price lower. Here's one. I thought I'd add a non-Nifty type market. This is just from last week in a session I was delivering. Let me just get rid of this here. There we go. And this is the big NASDAQ market. So I think most people around the world are familiar with the NASDAQ. Just to show you again, it's just a different market, same concept, same everything. We could be looking at any market on the planet. We'll be having the same conversation. There's a huge move in the stock markets over the past week. So we notice the demand zone here. Price is trading sideways. All of a sudden, there's a strong rally in price. Right? So again, the four components to structure are here. Location-wise, when price came back to the demand zone, notice where fair value was. And for those that aren't familiar with the NASDAQ, this is a big move, going from 15,600 up to 16,400. Most major equity index markets around the world had a big rally last week. And just want to share one with you. But when price came down to demand, okay, remember, competition to buy here causes it to turn, right? Fair value, which was right up here, is that magnet that pulls price right back to it. And sure enough, probably, don't quote me on this, but I think the last two, maybe 3 days of last week, price quickly just came up here and then just sat here most of the week, right? Same thing with most equity index markets around the world. This is where fair value was and is at the moment. It'll shift, it'll change, but again, whatever market it is, doesn't matter. Okay? And again, another way to say this, if we were buyers down here, we were just buying from people who are selling after a decline in price, mistake number one, into a price level where demand exceeds supply, mistake number two. Okay. Another way to say it, we're buying at wholesale prices. That's another word for demand, wholesale prices, from people who are trained and conditioned to sell at wholesale prices. And I know that sounds crazy. You say, well, who's trained and conditioned to sell at wholesale prices? It happens all the time, right? Every day, every week, every month. All right, let's keep going. So remember, last session we talked about keeping it simple, focusing on three things: fair value, which is location; a qualified supplier demand zone. And remember, four things must be present. We didn't go over these four last time. We went over one of them. We'll go over, I believe, one of those today. And then must be present to qualify a supplier demand zone. And then that opportunity must have a profit zone or risk reward scenario that we're okay with. Okay. I want to introduce something else here for more of an advanced, maybe we'll go back to this one here. Any of these are fine, actually. You know what? Let's just keep going forward because we'll just do this with the next one. Let me go back here for a second. So I want to introduce something for more an advanced thought. So most people that are focused on supply demand, buy at wholesale, sell at retail, when you're doing your risk reward, where your entry is and your target, right? We'll talk about the protective sell stop on the risk side in a moment. But when we're entry to profit target, right? For most people, that's the profit zone. Most people measure from demand to supply or supply to demand. I want to introduce something here that can help increase the probability of success, increase the probability of reaching your profit target. Instead of focusing on, say, a lot of people in their trading plan, they'll have, they'll say, I'm only looking for opportunities that offer me 3-to-1 from demand to supply, for example, right? That's what most people do. Or 5-to-1 from demand to supply, whatever your numbers are. But think about this for a moment. Let's add something here. What if we look at fair value and do the same thing? In other words, what if we say the only opportunities that are acceptable to me are ones that offer me at least 3-to-1 just back to fair value, not even to the opposing supply zone, but just back to fair value. Does everyone understand what that does to the probability of success? In other words, for this one, for example, here's fair value, right? That's not necessarily supply in this market. So we're just saying, hey, we just want price to get back to the middle. So in other words, we can find opportunities where, like in this case, this opportunity is offering us at least probably like 4 or 5-to-1 just back to the middle. Where here, that one's a good one too. But now look at this one. This one's fine, but this isn't offering, this is probably offering maybe 2-to-1 just back to the middle, right? Which is okay. But again, most people are trying to buy at demand and sell at supply and buy at demand. What I'm suggesting is we can find opportunities where we're offered ideal risk reward just to get back to the middle. Okay, that should and typically increases and improves the probability of reaching that profit target. Does that make sense? All right.
Yes. Sam, one question. How do you recognize and why do you suggest that this is the supply zone, that is the demand zone? How do we recognize that? As a trader, how do we recognize that? Can you give us some fair idea about it? We can line them up with the resistance and the support, demand and the support lines, supply lines. But how do we recognize them? Is it like you're looking at the volumes, you're looking at price?
No volume. We don't look at volume. We don't put volume on the chart or any of that stuff. None of that. So location, we talked about that a little bit, right? So that's a big part of it. And then here are the 4 pictures that represent demand and supply. So these are the patterns. But just because you have this pattern doesn't mean there's a big supply-demand imbalance there, right? That's why, like any of these patterns, right, inside of fair value, the likelihood of them working is low. We probably ignore 90% of these patterns on a price chart, right? Because a lot of people think, when I see, for example, rally-based rally, that's a demand zone. I should buy here. No, it's probably not a qualified demand zone. If it's inside fair value, it's not. The other thing, probably more specific to your question, is in number 2. So a qualified demand zone, supply demand zone. Remember, 4 things have to be present for it to qualify. We don't have time to go over all 4 of those today, but we can go over 1 or 2 of those. And let's start to dive into that next. So let me get through. Let me take us through this, and let's get to one that we talked about last time. Okay. Here's one of the 4 that we talked about last time. It's time, and this is one. It may not be the most important, but it's important. It's important because when you read the trading books or conventional technical analysis, that school of thought has this all wrong, right? Because a lot of people say they look for an area on the chart where there's lots of trading activity and say that must be a great support or resistance level. That must be good supply demand zone. And that's not the case. Think the logic through for yourself, and I think you'll understand, which is at price levels where supply and demand is most out of balance, are we going to get lots of trading activity or very little trading activity? If you really think it through, you'll see that the bigger the imbalance, if you look here on the screen like this, you're going to get very little trading activity. Because once these buy orders are filled, which is not going to take long because there's not many of them, you're going to have a lot of supply left over and price is going to fall quickly. Okay. Here, this is out of balance, but not by much. It's pretty close, right? It's going to take a lot of time for all these orders to be matched up. Once they're all matched up, you will have a few sell orders left over at the end, but it's not a big enough imbalance for us to take a trade. Does everybody understand that? If we look at the chart, here's what it looks like on the chart. All of this trading activity here, price eventually drops, meaning supply does exceed demand here. That's why price drops. But because there was so much trading activity here, there's not likely to be a big supply-demand imbalance. And we see when price comes back to the zone, right? It does stay here for a little bit. There's still some more sell orders to be filled, but eventually goes through the zone. This doesn't work. This would never qualify for us, ever. Not even come close to qualifying. However, when price reaches this level, where you have very little trading activity, we understand that that suggests a big imbalance. Price turns lower very quickly. Make sense? Again, it's only one of the 4
Yes.
components that has to be present for structure. We'll probably hold another session in time and go over more of it, but okay. And again, none of this is complicated. It's not like there's a ton of rules, but it's just, there are rules. So notice here, very little trading at the zone. Okay. And as you can see here, 5 candles or less is ideal. This is a rule that we really stick by, whatever time frame we're looking at. If you look at a bar chart, it should be 5 bars or less. But whatever type of chart you're looking at, that's typically what we stick to. Now, we never want to use one candle or one, right? We never want to use one as a supply-demand zone. But if you do see one, for example, candle on a chart, you say, wait a minute, that looks like a supply or demand zone to me. It's always a good idea to go down a time frame and look inside that area. All right, so here's a qualified demand zone. Okay, meets all the structure criteria and location criteria. Right, those 2 pillars. Price comes back to the zone. Yeah, go ahead.
So you're suggesting that in this case, the 3 candles demand, it's 3 candles demand because after the 3rd candle, the price gave a breakout.
Correct.
Right? So that's why it qualifies that it's less than 5 candles. And
yes.
That's why this will be in future, this part is going to be one of the zones. Like it will be a demand zone later.
Correct. I mean, there's 3 more things that have to be present for structure, but that's the one we're going over, yes. So that qualifies here. And here's where we want to be a buyer with our protective sell stop below and our profit target above. Okay, there we go. So let's keep going here. Now, I want to add something to this that another thing that we didn't go over last time. So here is, let me see, is that a good example or this one? It doesn't matter really. This is fine. So here's a qualified supply zone we were going over in our session. Price comes back up to supply, and notice here. Oh, let me mention two things. Notice this area. A lot of people would look at this as a supply zone, right? To what we were just talking about. But this, for two reasons, this would never qualify. One of them is there's too much trading here, way too much trading. This
more
zone,
than 5 candles.
Yeah, way more than 5. Absolutely. Here, this one qualifies, right? But notice price comes back and barely touches the zone and falls. That's because the supply-demand imbalance here is so big. So I want to introduce something here that we didn't talk about last time. Let's talk about our specific rules for entry, stop, and target. Now, again, in the full-blown course, and we'll have time to go over that in a future session, but it's we have it all out. It's a whole section, but let me just kind of go over it here real quickly. We don't we don't sell short at supply, and we don't buy at the demand zone. We enter our position just before the zones, okay? And we have a specific rule for exactly where that price is. For example, we'll use the number 10%, meaning let's say this supply zone from the proximal line here to the distal line, let's just say this is 10 points, okay, to keep it simple. 10% of 10 points is 1 point. So we would enter the position 1 price point before the supply zone. Okay. The reason why we do that, remember the logic is important. The reason why we sell short just before the supply zone, just like we'd be a buyer just before the demand zone, is because competition to sell at demand and supply, or competition to sell at supply is so strong, often price just touches the zone and turns, right? I'm sure a lot of you have seen that before. So we choose to enter the position just before we get to the supply zone, and that helps us get filled, right? Because at your supply-demand zones where you have the biggest imbalance, one of the biggest challenges you'll have is just getting filled, right? So we get in just before the zone.
Sam, you're saying 10% of the height of the demand supply zone, 10% of the height of the supply zone, right?
Yes, or the demand zone, whichever it is, correct.
Or the demand zone. So in this case, like if the height of this is, let's say 10, so you want 10% of that. So 1 point before that,
correct.
We have to be prepared and look at selling.
We have our order in the market ahead of time. Yes. Yep. Remember, we want everything to be rule-based. In our world, everything is rule-based. So the more rule-based you can make it, the less emotions come into play. I don't ever want to look at a chart and while it's moving and things are happening and say, okay, I think I want to buy there, and then wait for price to get there, push the buy button, and then have my finger on the trigger. Okay, I think I should get out now, so I'm going to sell. We don't do that. In fact, I don't know that you'll find. I don't have any stats on this, but I'd be surprised that you'd find anybody around the world that is successful, consistently successful trading year after year after year, that just wakes up in the morning, looks at their charts, and just starts clicking buttons, buy and sell buttons, right? It's just so important to have rules, set and forget the trades. Obviously, make sure you're good with the risk reward, and then just leave it alone. The more that we can take ourselves and our human emotion out of the equation, the better. That's why we have rules for everything. Now, the protective buy stop in this case, right? If we're wrong, we want to make sure that the loss is small and manageable. So for that, we use the number 20%, right? So same thing, whatever the zone is, and whatever 20% of that is, we put that just above the zone. So if it was 10 points from top to bottom, the protective buy stop is going to be 2 points above the zone, right? And that's to give us the best chance in the trade. The profit target, we use the number 80%. Okay, so we don't. If we sell short here, we don't buy. Our profit target is not at the demand zone. It's 80% of the available profit zone here. 80% of whatever the distance is from this to this. Let's say this is 100 points. Right? Our profit target would be 80 points of that. And we can enter this entire position, entry, stop, target, before price gets there, be hands off, never let our emotions get in the way. Does that make sense? Now, let me say something here, very important. You can change those numbers, right? I'm just telling you what our rules are, what we stick by. That 80%, for example, if you want a higher winning percentage, you might want to try making that number smaller. If you want to go for a bigger move, but maybe your winning percentage will go down a little bit, make the number bigger. But in this case, having the rule is almost more important than what the actual rule is. Does that make sense?
Yes, yes.
Okay. And I know we didn't get into this last session, but the purpose of today's session is to kind of take what we talked about last time and just more advanced. And again, it's a little tricky for me because I know we have brand new people with us today, but we also have people from last session. So, all right, let's.
And Sam, I'm loving the session. I'm personally making notes of what you're saying.
All right, at least we have one person that loves it. We're good. Let's keep going then. No, I'm kidding. We'll just try to, let's look. Every time we're together, anytime we have a session together, whether it's over the computer, on the other side of the world, which is the case today, or whether we're in person somewhere in India or somewhere, we always want to make the most of our time together, right? Whether it's our first time together, whether we've been together for a while, anytime we spend time together, we're all giving up time to be here, right? We could all be doing something different, but we choose to be here. So let's always make the most of our time together, and let's always make progress. Okay, so let's keep going. Now, we did not talk about, here's another thing we did not talk about last time at all. And it is, so remember last time, like we're talking about today, it all comes down to two things, right? Understanding how the markets work, which is supply, demand, and fair value. And then using our two pillars, structure and location, to map it all out. All right? So I want to just say that that's good enough. We don't need to do anything more than that. However, there are some other things we can look at that can help us assess the probability of success or risk reward even deeper. But what we're looking at now, you don't need this. But this can it's like, think of your favorite cake that you eat. I don't know, and I just thought of that. So this is probably not a great analogy, right? Whatever your favorite flavor cake is, and it's got your favorite icing on it, that's probably good enough, right? You don't need the sprinkles or the other thing they're going to put on top. But if they put it on, maybe you like it even a little bit more. That's what this is. So if these are things that we absolutely use to identify that the probability of success is higher or lower, right? But this is stuff to add on to what we're talking about. So it still comes down to supply, demand, fair value. But we have three probability enhancers. We're going to go over one of these today. Secondary evidence, inverse markets, and news. We apply these equally to any market and any financial purpose. Now we're going to cover the first one here today, but let me talk about the middle one for a moment. The middle one we do use, I know for our own trading and for our members and stuff, we're always focused on inverse markets. In other words, remember that NASDAQ into demand I showed you that we had this last week, right? That was a big move up in the NASDAQ from demand. At the same time the NASDAQ was into demand there, and I'd have to go back and look at the Nifty, but chances are the Nifty was also into demand. But at the same time, that market, that major equity index market was into demand, we had some bond markets into supply. And there was another key inverse market that was into supply. So we're very focused on those high probability events. Was the NASDAQ and Nifty and other markets into demand enough with the profit zone above? Yes. Does it help that key inverse markets are also into supply at the same time? Absolutely, right? It's a big deal. What that does for us, I can tell you in our own trading with our rules, we will take a certain position size and risk a certain amount of money with that major market into demand with the profit zone above in and of itself. If there's an inverse market or two also into supply, we actually increase our position size and risk allocation. It doesn't mean we're ever risking more money than we're willing to lose. It's just a higher probability opportunity. Therefore, we're willing to risk more money on that. Does that make sense? Hopefully, I explained that the right way. So we don't have time to get into this. Now, in every market we look at, every market that we look at and trade in India has key inverse markets with it. Every market, any major market around the world has inverse markets that we can focus on. So we'll dive into this in another session. But today, let's focus on this first one: secondary evidence. Take a look. So, as I said, look at this demand zone here. When it comes to structure and location, this demand zone qualifies in and of itself. And however, we also have secondary evidence. What is secondary evidence? It's this. You see this little pullback here? Right? Here it is too. This is just the chart blown up. When price comes back to the zone but cannot get there and turns like this and moves higher, we call that secondary evidence. It helps confirm that there's likely to be a big supply-demand imbalance here. Remember, the zone itself is enough. When this zone qualifies when it comes to structure and location, okay, that tells us that there's likely to be a big supply-demand imbalance here. When this happens after that, right, that gives us more confirmation that there's likely to be a big supply-demand imbalance here. The reason why price can't get back here again, the supply-demand imbalance here is just too great. You can't even get there. Does that make sense? Therefore, this becomes a higher probability buying opportunity. Okay. And for those of you that maybe have watched some of the stuff from supply-demand stuff, on YouTubes and stuff like that, videos on the internet, or maybe you've learned supply-demand stuff somewhere else. You've probably never heard of this secondary evidence concept. That's because we don't put this stuff out there. There's stuff we don't put out there. It's not that we're trying to, hold back or anything, but, it wouldn't be fair to us or our members. Does that make sense? But I want to share it with you here today. So this is one of the things. There's a couple others like that also. So that is what secondary evidence is. Let's take a look at more examples. Okay. Again here, the supply zone, the qualified supply zone here, good enough. However, notice here, price attempts to come back to the zone, can't even get there. Why? Supply-demand imbalance, in this case on the supply side, is too great. Huge amount of unfilled sell orders here, right? And price can't even get there. That makes this a higher probability event. Notice price just touches the supply zone and falls. Not surprised, right? No coincidence that price just touches the supply zone here and falls. This suggested that was likely to happen. Does that make sense? Right? And, even still today, more than 20 years after I was on the trading floor with, big stacks of paper orders, when I look at charts like this and we talk about this, even though we're looking at candlesticks on the screen, my brain still visualizes what this looks like when it comes to the actual buy and sell orders, the actual supply and demand equation here. This is a huge amount of sell orders, right? So big that price can't even get there this time. So big that when it gets here this time, it just touches the zone and falls. Does that make sense? But again, to keep it simple. Yeah.
Sam, I was also looking at the Nifty charts, like your primary setup, which you just shared with us. Uh-huh. It's amazing. It's working there amazing.
Yeah, the Nifty. This works on any market, but I'm sorry, go ahead.
Sorry, this time also, one of the supply zones, the Nifty low which it made on 29th November, it actually just touched your supply zone, demand zone and moved back.
Okay, no, that's not surprised.
Amazing,
No,
that's amazing.
Good. So, and what we're talking about here, we're just talking about supply and demand, right? So this is how every market works. Now, one thing I've noticed, I've been to India a number of times. We've been, going over all this, not all this, but we've been to India a number of times. And one thing I've noticed when it comes to I'm very, very familiar with the Nifty chart. Look at it all the time for many, many years, and many, many markets in India, which are great. But one thing I notice that makes India a little bit different is that so many people take action on news. There's such a huge focus on the news. And you see people, their urge to buy and sell when it comes to news is so strong. And that's why you see the Nifty gap so much. But when you see the gaps in the big turns, look to the left. They're almost always at these supply-demand zones, right? So trading the Nifty and markets, obviously in the Nifty, it's great when it comes to the supply, demand, and the turning points. But be careful. In other words, in India, maybe more than most other markets, it's so important to focus, make buy and sell decisions based on what's real, not what you feel. There's too many people making decisions on what they feel. And what you were just saying, the Nifty coming down to demand there and turning. Remember, there were people selling down there, right? The point is, you don't want to be one of those. There's people buying right here. Why are they buying? It makes no logical sense, right? But they do. It's because they're buying based on what they feel. They're buying here because they think prices are going to go higher. There must be some strong news event. Anyway, I know we're pretty much out of time here, but let's look at a couple more. Okay. This one is a little subtle, so let me share this one with you because you'll see this type from time to time. Same thing, secondary evidence, but let me go over this one. Notice, this chart's kind of small, so let's look over here. It's the same thing. Notice price. Here's a rally-based drop, qualified supply zone, which again is enough. But notice right here, quickly price attempts to come back to the zone, can't get there. Right? Can't make it. The difference here is it's very quick. So even looking here, you may not even see it, but it's right there. So you want to watch for that. That'll happen often as price quickly attempts to come back to the zone and can't. Then drops further, opening up a nice initial profit zone. And again, this secondary evidence right here makes this a higher probability opportunity and turning point. Okay? All right. One more. Let's go over this one because it's just so important. So how about this? Let me ask you a question. Take a look at this. Let's look at the chart on the left. This was the setup before price came back to the zone. There's one other thing in this example that suggested a big supply-demand imbalance at the zone. What was it? Does anybody have the answer? What also suggested a big supply-demand imbalance at this zone? Let's kind of put everything together that we've been talking about.
The gap up there?
The gap, absolutely, right? So when our minds are really in this kind of supply-demand world, these things should jump out at you. So notice, very little trading at the base. Price then gaps up. So those two things are suggesting a big supply-demand imbalance here. And remember, we haven't gone over the four components to structure, but these two suggest that. Then, notice price almost comes back to the zone here. See that? It's right there. Almost. Doesn't touch it, though. Secondary evidence. Okay. Then eventually price comes back, barely touches zone, takes off in the opposite direction. Why? Huge supply-demand imbalance here. And if you have this razor-sharp focus on what's real, not what you feel, the chart is screaming that at us right here. It's all about the evidence, right? Make sense? All right. On that note, I know we went over all this last time, but let me just leave you with, let me leave you with this thought right here. We could probably wrap up. I know we're out of time. Never enough time, but anyway, one of the things I can leave you with again to just help your mindset be in the right place, whether it comes to day trading, swing trading, longer term investing, whatever markets you're looking at. Just remember that how we make money buying and selling in financial markets is exactly how we make money buying and selling anything in life, and that's really the filter that is a good one to kind of remember, right? You can't buying at wholesale, selling at retail. That's how it all works. I'd love to say it's fancier and more complicated than that, but it is what it is. Anyway, it was great to be with you, and great to be with everyone again. And
It was it was great to be with you, Sam, as well. So my personal takeaway from the session, whether some issues with I'm not able to see the audience chats, but my personal takeaway from this session, particularly like look at the primary evidence, where we look at trading happening for less than 5 candles. That gives us some idea of the demand and the supply zone. That's at the higher level or the lower level. Then initiate trade, it should be like if it's at the base, demand zone is at the base, 10% before the range of the demand. So if your range is rupees 10, then 10% of that is 1. So initiate your long when it starts coming down. That's where you initiate it. Stop loss will be around 20% below the demand and the supply zone. So in this case, the demand zone, below the demand zone, 20% below that will be the stop loss. So that's 2 rupees below the supply zone. 2 rupees below the demand zone in case we are creating long. And target will be 8 times the demand and the supply height.
Yeah, something less than the available profit zone, which would be from demand to supply. And then the big takeaways I think are also those are the details. Remember, today's session was meant to be more advanced than the first session, but it's really understanding how and why prices move in markets, which is just supply, demand, and fair value. And then those two pillars of structure and location. Those are the only rules and pillars that we want to follow. And today we introduced a few more things, and all of this is there's a lot more in the full blown course that we can go over, but we'll plan sessions at a later date and cover more.
And studying this, Sam, you would agree with me, it's a study of a lifetime. You have to keep on learning and learning, keep on fine-tuning one's studies.
Hello, sir.
And working on the rules on different indices,
Hello.
stocks. So it's a lifetime of study. You keep on learning.
Hello.
I mean, from my experience, a lot of people learn this the wrong way. They learn it backwards. They use like we talked about last session. They use indicators and oscillators that have you buying after a rally in price, which doesn't work. They use trend, which has trend traders don't buy at demand. They let prices turn higher in demand. Then they wait for a series of higher highs and higher lows, and then they buy. They're buying right in the middle. So all of the most popular trading strategies and technical analysis and all that, the major flaw is you're buying after such a big rally in price and you're selling after such a big drop in price. So for a lot of people, it's unlearning before learning the right way. But it's really just this razor sharp focus on how markets really work. It's mastering the basics. That's what I like to say, because once you get, and it's not a lot of basic, and there's not a lot of rules, but it's just getting that, mastering that, and just sticking to it. If you think about sports, right? Sports, any sport around the world, when you play it as a little kid to the time you become a professional, what's the only difference? You're just able to do the basics much faster. That's it. You don't, right? When you start to get outside or away from the basics, it doesn't work, right? So it's the same thing here. People overcomplicate this, and the internet certainly helps people overcomplicate things. But anyway, try to keep it simple, try to keep it real, and there you go.
Right, Sam. Thank you very much for the lovely session. And like you rightfully said, before getting into the concept, one should unlearn first. So it's all about emptying the cup before filling it up.
Yeah, and the fortunate people are the ones that come to this with an empty cup. They tend to get it pretty quick. But anyway, there's a path. There's a path for everyone. All right, good to
Right.
be with you.
Good to be with you, Sam. So, audience, I hope you have been all enjoying it. And now, after this session, we'll have a very small 10 minutes break, and then we'll start off with our next session, trade management using uh, directional indicators from Neeraj Gogoi. So, thank you, and just be around. Have a Hello, friends. Welcome back to our next session on identifying the demand and the supply zone and trade management using directional indicators. So, the first session was on identifying the demand and supply zone. The next session, now, or the current session, is going to be trade management using directional indicators. So, people who are pro, they may or may not use directional indicators, but it's always good to take support of the indicators from time to time. So, before we start off, let me give the event disclaimers once again that trading and investing is a financial transaction which is subject to market risks. Whatever we are sharing here is clearly for knowledge purpose and not any recommendation. Please check your personal risk appetite, use your knowledge, and refer to your trading rules before investing, and most importantly, stay disciplined. So, for the next session, I would like to invite a very good friend of mine and my co-worker and my co-edu coach with Paytm Money, Mr. Neeraj Gogoi. Neeraj has over 2 decades of trading and training experience, and he was the few people in the industry who had started training on futures and options back in 1920s when it was on the verge of like getting introduced or it was introduced. So, Neeraj, welcome to our session today.
Hey Shankar,
Hi.
should I switch on my camera?
Yes, please.
Just give me a second. Good evening, everyone. Thank you, Shankar, for giving such a wonderful and nice introduction.
And Neeraj is someone he is quite pro with demand and supply theories and especially advanced option strategies, which he keeps on sharing with me also at times personally. And yes, and off to you, Neeraj. And in between, for clarification of doubts and all, I may stop you in between and ask you questions. Let's keep this a bit interactive. What do you say?
Absolutely, absolutely. In fact, Shankar, when Sam started coming to India in 2010, I was one of those first students who actually learned demand and supply trading, and it was really very powerful. In fact, it's a very because it's all about anticipating the turning point when the market goes in one direction. For example, a few days back we saw market was falling, so that now you need to anticipate before turning back where the market is going to turn. Now, similarly, when the market goes up, you need to anticipate that where the market is going to turn down. So that is the supply zone. Now, over the years, of course, Sam is a hardcore, he's a creator, he's a guru of demand and supply trading. So definitely he does not want the things to be diluted. He wants everything to be in absolute purest form, right? And we being Indian, what we did is that we did a little bit of here and there. We found that because, again, to be very honest and frank, we have been using conventional technical indicators from 2000, 1999, 2000. I have been using MACD, RSI, stochastics, moving average, all these kind of indicators. So it is literally impossible for me to get, rid of those things which it's there in my blood. So what we did is we mixed both. One side the conventional technical indicators, and one side the demand and supply, and then we found what is the best way to trade, and that is what I'm going to share with you today, all my participants. In fact,
Neeraj, I would like agree with you on this. See, you are a demand and supply trader. I'm a price action trader. So my style is price action. So I'm a price action trader. But somewhere we always keep mixing things.
yes,
Is it good? Like you said, like we Indians, how can we
yeah,
have a
absolutely.
good, nice cook without
Yeah,
using spices? The spice. So
okay,
off to you, Neeraj.
okay. So I believe in one thing, and that is probability. See, we are here in the market to take trades. We are here in the market to take trades which have got the best and the highest probability. Method is one side. Method is always there. But ultimately, a trader's responsibility is to identify a trade which gives a better probability. And I found that when I mix both demand and supply in one side and the conventional technical indicators in other side, so there are two set of parameters. One is the decision making parameters, that is the demand and supply, of course, as Sam said. The demand and supply is a decision making parameters. You cannot bypass that. The second set of things are decision support tools or parameters which support your decision or increases the probability. And there comes all the conventional technical indicators. Now, even if my conventional technical indicators gives me a buy signal or a sell signal, but my demand and supply criteria is not meeting, then I will probably not take the trade because that is not an ideal trade. So that is how we approach the whole thing. And of course,
So you are saying demand and supply is the base, and you use indicators
yes.
to initiate the trades and
No,
to validate that.
We use the indicators to support. It is a decision support tool. It is not a decision making tool.
Right. It's a validating
demand and supply is a decision making tool. Yeah. Okay. Now I'd like to share my PPT as well. Of course, can I share my PPT?
Please.
Okay. Can you all see my presentation?
Before we just start off parallelly, let me just share this. Audience, you will start getting your questions coming up right now on the screens, which you can start answering. So parallelly, you can start answering for your first prize, right? So the martial speakers. Yes, Neeraj.
Okay. So that is, I heard when I was listening to Sam, I think there are a few points still need to be, he was emphasizing a lot on the structure and location. So let me throw a brief light before I get into my thing. What is a structure? And he have shown one slide, there are 4 graphs were there, 2 graphs on one side and 2 graphs on the other side. I would just like to quickly explain those who could not understand or who is coming for the first time. I'll just go to a white screen. Now I will just open my pointer pen. Okay, can you see my white screen, Shankar? Okay.
Yes.
Okay.
Very clear.
Now, very good. Now for demand zone, there are basically 2 structures, and one structure is what we call drop, base, and rally. Okay. So what do you mean by drop? You will see the prices falling, and prices falling. This is what we call drop, right? Because the price is continuously falling. And then in one place, the price stop falling and start moving sideways. This is what we call the base. That Shankar was again asking how many candles should be there in that area, not more than 3 or 4 candles. So this is what we call the base area. And after that, you see a very sharp rally in the price. Okay, sorry, this slide has come. Now this is called, don't consider this line. This just came. So this is what we call drop. This is the base area. And then there's a very sharp rally. So now your price is here. Okay, your price is here. So maybe the price has started moving up and down, up and down. So when you look back, under the price, then you notice this area. This is what we call the base area. You notice there's a drop in price, there's a base in price, and then there's a sharp rally in price. So what you are going to do is you are going to mark this area, right? You are going to mark this area. Excuse me, my lines are not very perfect. I'm just trying to draw it. They're not. This is what is called a demand zone. They are straight lines. They're not like this. They're absolutely straight lines. And Sam mentioned 2 words called distal line and a proximal line. Okay. So this line is called a distal line and this line is called a proximal line. Okay. So this is what we call the demand zone. So once you mark the demand zone, what you do is that you wait for the price to come back to the demand zone. Okay, maybe it will take few days, maybe it will take few probably weeks, or maybe it might just take few hours. So once the price comes to the demand zone, what you do is that you buy the stock. Okay, you buy when the price comes to the demand zone. Now, when you buy it, as Sam said, you have to buy at least if this is the breadth of the demand zone. If the breadth, the distal line and proximal lines difference is 10 points, then there should be 10% above this distal line, proximal line. You'll have to initiate your buy. It means before touching the demand zone, that is 1 point before touching the demand zone, you have to buy, and you need to put the stop loss 2 points below the demand zone. Okay, distal line 2 points below the distal line. So this is the first thing. Please remember, this is what we call the drop, this is the base, and this is the rally. Okay, this is one structure. Now the second structure of the demand zone is what is called rally, base, and rally. Now what do you mean by rally, base, and rally? The price is moving, price is moving, price is moving. This is what we call the rally. And then the price stopped rallying and started moving sideways for some time. This is what we call the pause. The price took a pause, started moving sideways, and then there's a sharp rally again, right? This is a sharp rally again. So now you are somewhere here. So when you look back, you saw this is the base area. You saw the base area. The price came, rallied, and then it paused in the base area and then started rallying again. So what you are going to do is that you are going to mark the base area. Sorry for my lines are not straight. I'm using my mouse. So this is called the demand zone. Now, once you mark the demand zone, you are going to wait for the price to come back to the demand zone. And once the price comes back to the demand zone, you buy again and put the stop loss below the demand zone, right? Now, this is what we call the structure. This is a demand zone structure. Now, I'm going to remove, just a sec. I think there is, this thing is here. Eraser. Okay, so just a sec. Okay, now
Very nicely explained. Very nicely explained.
Thank you so much. Now this is what is the demand zone, and now we are going to go for the supply zone very quickly. So what is the supply zone? Just the reverse mirror image of the demand zone. So the concept, the structure of the supply zone is rally, base, and drop. So price was rallying, price was rallying, price was rallying, and price was rallying. We have seen that rally, price moves very sharply. And then at some point of time, the price stopped rallying. Okay, they start moving sideways or pause. And then what we see a very sharp drop in price. Okay, this is what is called drop. So when I look back, I saw the base from where I have seen the price falling very violently and sharply. So what am I going to do is that I'm going to identify the base candles. There are 1 or 2 candles here. I'm just trying to draw the candles. There are 1 or 2 candles here. And these are called base candles. Okay, just trying to draw 2 base candle. So I will mark the base candle, identify the base candle. And once I identify the base candle, I'm going to mark the base candle. This is the base area. And once I mark the base area, this area is called the supply zone. And once I mark the supply zone, I wait for the price to go to the supply zone, right? And the moment price comes and touches in the supply zone, I sell, right? Why do I sell? Because I anticipate that the price is going to fall from here. Okay, why?
So here in this case, Neeraj, do we wait for it to touch the line, or again, like Sam said, 10% below?
10%, yes.
Okay.
In fact, usually it is, if this imbalance is extremely high in this area, okay, if suppose this is a very powerful supply zone, again, the condition, what are the condition that makes a supply zone a strong supply zone, or what are the conditions that makes a demand zone a strong demand zone? Okay, I'll come to that. But if this zone is a very strong demand zone or a supply zone, then I will not even wait, because prices barely touch or kiss the zone, and then will start falling, and you will probably not get the fill. You will not be able to get execution of your orders. Okay, so you just 1 point or 2 points before that zone, you sell, and put the stop loss above this supply zone. So this is what is a supply zone ka
2%.
2%.
2% above.
20%, 20%,
20% of the height, sorry.
20% of the breadth of this zone. Okay, 20% of the breadth of this zone. So this is one structure. This is called rally, base, and drop. Now the second structure is what is called drop, base, and drop. Okay, the price is falling, price is falling, price is falling, price is falling. Or there could be one long candle also. It's not necessarily that the way I'm showing, because when you look at the chart, it all comes in a different size and a shape. Okay, so you see the price falling, and then at some point of time the price pause. It started, the pause could be a one candle pause. The pause can be a two candle pause, or maybe a three candle pause, but it should not be many candle pause. Okay, and then there's a fall again. So once you look back, then you saw this is the base from where the price has fallen. And once you mark that area, you identify the base candle. The candles in this area are called the base candles. And then you, again, how to again mark the zone? Let me show you very quickly. Now, suppose this is a base candle. Okay, मान लीजिए ये आपका, this is the base candle. Okay, now this is the base candle. This is the candle here. Okay, this is the base candle. Now this top point here is going to be your distal line. Can you see that? The top point, extreme high, the highest high, this is called the highest high point, is going to be your distal line. And you can take the full length of the candle or the body of the candle. Okay, this is a two ways. You can take this also, but I take this. So this is how the supply zone is, or the base candle is drawn. Okay, so this is what is a supply zone, and when the price comes and come closer or touches, usually theoretically it should come and touch the supply zone, and that is where you take your trade, guys. So this is what is called the location. I'm sure now this concept is clear to all of you. Now I'm going to show you one thing. This is how a real chart is. So what you do is that you start looking back. Now this is a little bit older chart, but it does not matter because we are going to explain the concept here only. Now look at here. So this is where the price is right at this point of time. This is where the price is. Okay, this is where the market is. Now you need to find a demand zone. So आप क्या करोगे? What will you do? You will look back under the price. You will look back under the price. And then you look for a pattern when there's a drop, base, or rally. And here you found a pattern. Can you see that? This is a drop. This is the base. Okay, this is the base. Let me identify my pen. This is the base area. This is the base candle. And then this is the rally. Yes or no? Can you see that sharp extended range candle? It is extremely powerful candle.
Yes,
now the question is
reached your, and the candle number of candles are also less than 5.
Absolutely. Now this is the number of candles are only 2 candles, or you can say 1 candle, 2 candle, and this is a very powerful candle. So logically, if you think who might have bought in this candle, is definitely the institutions, right? Some big traders, big institutions might have bought this candle. So it means there's a demand present in this area. So what you are going to do is that you identify this base candle, mark the base candle, and this is what is called a demand zone or the demand area. Okay. Now the supply area के लिए वही chart में what you are going to do is that you are going to look back, you are going to look back, you are going to look back, and then you will have to look for a rally, base, and drop. Now can you see that this is a rally in price? The price was going up, or look at this portion as well, and look at the whole rally. This is what is called rally. Price was going up, price was going up, and now this is the base area. Now this is the base candle. You are going to mark the base candle. And when you mark the base candle, this is what is called the supply zone. Okay.
So in this case, you recommend we take only one, or shall we take the 3? One, the one before and the one after this candle, and then that should be the zone. I'm just asking.
Yeah. Yes.
Can we take that as the zone or the single candle? What do you say?
This is the last candle. Can you see that? This is the turning candle. This is the turning candle. Can you see that?
Yes.
Now, this is the turning candle. The extreme peak of this candle, that is the highest high of this candle, and the body of the candle I have taken. And this includes the body of this candle as well. Okay. Now, one thing is here. See how big is your size of this zone impacts the risk to reward ratio, or rather risk of the trade. Ultimately, what is your risk? Because you have to initiate your trade, you have to sell here, you have to put the stop loss here, right? Now, if the zone is bigger, suppose you take this candle as well, right? The zone is going to be very big. Okay, so when the zone is very big, your risk is also going to be very big. Okay, so this is one concept. So to reduce the risk of the trade, what we do is that we take the extreme base candle and a body, the highest high of the candle and a body of the candle. Okay, so second thing what you have to do is that you have to look back further, you have to look back further, you have to look back further. Again, you have seen another drop base, a rally based drop, rally base, and this is a drop. Can you see this? Now here there are quite a few candles are there. 1, 2, 3, 4 candles are there. Can you see that? So it is almost coming to the borderline in the number, in terms of the number of candles. But still I will consider it, because see the two extended range candle, huge candles. So it means definitely big imbalance in favor of the sellers. There's a massive supply is there at this point of time. So still I will consider this as a very, very powerful zone. So as a trader, when I do my homework, I'll have to keep finding the zones. Okay, I'm sure this point is clear, Shankar, because our chat is not working. You are the only person whom I have to rely whether you understood. So I'm assuming that our other participants are also.
I have, like, Neeraj, I have completely emptied my cup. So I'm asking you questions like a layman.
Yes.
So I think that would help.
Actually, we are so sorry that today actually we are not being able to take the direct questions from our participants. Had it been, it could have been much more interactive. But anyway, we are trying our best to make it as simplified as possible, so that you at least take the concept home today. Okay.
And also, Neeraj, not to worry, for the audience, not to worry. On 16th, which is this Thursday, we are having a Q&A session with the audience directly.
Okay.
So we will be sending them the link,
and there will
for the Q&A, and we will be, they can directly ask and speak to us.
Okay, that's wonderful. Yeah, that's wonderful.
We are doing that.
Very good. Thank you.
Let me just re-announce the date for the audience. That's going to be on 16th, which is Thursday, and that time is going to be 6:30 to 7:30 p.m.
Okay, wonderful.
Yes.
Okay, now let's move forward. Right now, one very important question: what makes the zone powerful? Why this zone is powerful? Should I take the trade again? I will quote Sam, and he said that all demand and supply zones are not worth taking a trade. There might be a demand zone, but I might not take the trade. Okay, there might be a supply zone, I might not take the trade. So here he used the word called qualified zone. So what do you mean by qualified zone? Okay. Now here, of course, this is where I'm explaining the distal and the proximal line. Can you see that? This is a distal and a proximal line. Now, okay, it's a supply zone, distal and a proximal line. Okay, distal. Now let's come to what makes a zone a powerful zone. Now this is the first point. This is called explosive move from the area. Now this is a drop. Can you see that? This is a drop. Yes or no? Yes, this is the base candle. Do you all agree? And this is the rally. Now you tell me, Shankar, how is the rally? Is it a strong rally or a weak rally?
Very strong rally.
It's an absolutely powerful rally. Who might have bought in this whole rally? Who might have driven this whole rally? Obviously, big institutions, retail traders do not have the capacity to make the price move like this, isn't it? So it means,
you're right. Neeraj, I have one question again.
Yeah.
Just like, as I'm representing the audience, I will come up with all kind of, questions, which not just showing profitable trades, but also a bit of loss-making trades. Okay. Now, you see this rally when it was coming down, somewhere just above, can you see there are around 5 candles which created that base after the gap down? It created that 5 candle base.
Wait.
Yes.
Huh.
And then it reached the high, and then it came down and reached the low.
Okay, I think Shankar, now let's focus on the whole structure of the thing. Okay, we'll.
So why can't we take that as a breakout and then trade?
No.
Or is it like it's okay? That's a probability trade.
No.
So loss happened.
Shankar, at this point of time, where are you? Look at the chart. At this point of time, where are you in the chart? Tell me, where are you in the chart? You are here.
Okay, you're talking about currently where we are.
Yes, you always look back from the current context, current situation. Okay? So at this point of time, where are you? You are right here.
Okay.
So what you have to do? You have to look back. 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 And as you start looking back, can you see this is where I saw my demand zone? Yes or no?
Yes.
This is why I have marked this as my demand zone. Okay? Whatever might have happened in the past, because we don't know, there might be many things, but forget about it. So
But Neeraj, if let's say I'm trying to trade, and I see this that the candles consolidated and gave a breakout, and then it came down and hit my stop loss, it's absolutely okay. Ultimately, it's a probability trade, isn't it?
We'll discuss about those things slightly afterwards. Now let's at least conceptually, theoretically, we'll discuss. See, there is always a difference between theory and practical, right? Right now what we are doing is that we are theoretically
the concepts.
Yeah. So once the theory is clear and you really get into the trading, and that is why the stop loss need to be 20% below the demand zone, from the breadth of the 20% below the breadth of the demand zone. That is the reason why, because many a times the freak trades happens. Because of the freak trades, suddenly we'll see that zone is getting violated, and next moment you'll see that price starts shooting back again. To avoid that situation, as you said many times, that is why we put the stop loss below. Okay, so this is the demand zone. You see a very sharp rally from the demand zone, and then you wait for the price to come back to the demand zone and you buy it here again. Okay, so the first condition is a strength. There should be an explosive move from the zone, and this is the origin of the demand zone. Okay, now second important point is a freshness. That is what we call freshness. Okay, so how many times the prices come to that zone? Is it coming for the first time? It is coming for the second time. Now here, this is the zone. Can you see? This is a rally. This is a base candle, one candle base candle, and this is a drop. Now this is a zone, and the price comes back to the zone. You already taken the trade. Prices come down. You shorted, and the prices come down. You made money. Now here, price is coming there for the second time. It is the first time. It is coming here for the second time. Okay. Now the question is, always the first time when the price comes to the zone for the first time, the zone is the most powerful, because the power is absolutely intact. Whatever imbalance is there, it is absolutely intact. And this particular thing might have already consumed some of the strength of the zone. So next time when the price comes to the zone, I will not take the trade. I will not short at this point of time. Okay. So that is one condition to increase the probability of your trade.
Again, if you can repeat it, Neeraj, just why we will not short
So,
it?
because, see here the prices come for the first time. You have already shorted. This is a supply zone. Here price is coming for the second time. So as a high probability trader, when price comes to the zone for the first time, that is the time you should take your trade, not in the second time or the third time. Now, in exceptional cases, when the zone is extremely strong, that is the time when the second time also it might work. It will work. Okay. But again, for that we have got different conditions to take the trade. Okay. Probably you will have to take help of some of the other support tools. So we'll come to that. But your trade is ideal when the price comes to the zone for the first time. Now, the third condition is how much time. That has already been discussed. Number of times. See here, so many candles are there in that zone, right? So again, we discussed it in the past. This is not an ideal zone. So if in the zone, the price is spent too much of a time, then you are not going to take your trade. The third area is risk to reward ratio. How far is your profit? Now, when you buy in your demand zone, this is your demand zone. Your target is your corresponding supply zone. Okay, the corresponding supply zone could be here, corresponding supply zone could be here. So ultimately, it is a how far the corresponding supply zone. Now, here, this is a risk, right? This is a risk. Now, if my corresponding supply zone is right here, then my risk to reward ratio is not favorable in this trade. Can you see that? I'm taking this much of risk, but my reward for the trade is going to be only this much, because my practically afterwards the price might go past also. That is a different thing. But while I'm planning the trade right now, I'll have to take the target as my corresponding supply. So if this is my corresponding supply area, then my reward is very less. So I'm not going to take a trade. But if my supply zone is here, for example, I had got a wonderful trade. Can you see that? What a wonderful risk to reward ratio in this trade. Only this much of risk, but this much of reward I have got in this trade. Okay?
8 times.
Yes. Now the question is, because I'll just erase the whole thing. Okay. Now, because your corresponding supply zone is far away, is it guaranteed that the price is going to go to the supply zone? The answer is no. The price might go here and it might turn back from here. Price might go here, it might turn back from here. Price might go a little bit high and it might turn back from here, because it's a market. Anything might happen, right? So therefore, what comes into play is a trade management. So how will you exit from the trade? Okay. So yes, there's a condition called trailing stop loss. Your best friend in a very good trade or in a trade is called trailing stop loss. When you have got a winning trade, the price is already started moving in a direction. Let the price run, let the price run, let the price run, let the profit flow. And what you are going to do is that you will simply keep trailing your stop loss, keep trailing your stop loss. Now the question is, how will you trail it? Okay. Now let me quickly show that as well. Okay, this is what is called the trailing mechanism. Now, suppose you have bought here in this is a demand zone. Okay, let's mark here. This is a demand zone and price had come and you have bought here. Okay, you bought in this demand zone. Now, the price, you put your stop loss here. You put your stop loss here. So, as the price start moving, okay, this is perfectly fine. Now, if the price started moving, so first time you have seen that the prices pull back, and then it started rallying again. It made a small low here. So this is the time, the moment price started turning back and crosses this particular point, this is the time that I'm going to shift my stop loss for the first time. I had the stop loss here, right? So at this point, the moment price crosses above this particular point, I'm going to shift my stop loss to below this peak, below this bottom. Can you see that?
Yes.
Now again, let the price continue. Maybe price going up and down and up and down, no problem. Now suddenly price has gone up, and then the moment price makes a new high here, price suddenly made the new high. So now I'm going to shift my stop loss to this point. Can you see that? So there are two things: by how much the stop loss need to be shifted and when. This is a two important question. So when the price is making a new high, right? And secondly, by how much? By this much. So from this point, you are going to shift the stop loss to this point. Okay, this is how. And the moment at this point of time, if the price start turning back from here, you already have got this much of profit intact. You are going to exit here, and this amount of profit is going to be absolutely intact for you. Okay, so this is what you have to very mechanically. There is no emotion here. It is absolutely done in a very, very mechanical way. Just identify what is the lowest point, price turn back from here, and shift the stop loss below that point. Okay, the moment this high is broken, shift the stop loss. Okay, this is
Here's one question.
Yeah.
One question. How much should I place the stop loss at? Should it be based on the candle? Should it be based on some
No.
other demand and supply zone, or should it be based on percentage?
Shankar, this is when we no. Shankar, when you shift the stop loss here, this is the lowest point here. There is nothing called candle here. The lowest point. Okay.
So can you just show it the chart, or maybe here, where ideally?
It's okay. It's okay. This is absolutely, see, the price is going up like this. Okay. Now there must be a candle here. Okay. So just below the candle.
So in this case, which you can see on your screen. Yes.
Yeah. No. So this is not the
around
screen.
4,000.
This is don't refer to this chart. This is a different context. I'm talking about trade management.
Okay.
Here we are talking about risk to reward ratio, right? Here we are talking about how to exit from a trade. Okay, or rather, I should have taken a complete blank page without. Otherwise, people might be connecting. So this is a completely different thing. This is about your exit management mechanism. Okay, now these are what the things I have explained. I'm sure at least few things. If you were confused or if you could not ask before, you are getting clear now. Now let's talk about very quickly about technical indicators. Now, one of the important things that we use in trading is called multiple time frame analysis. Okay, I don't know how many of you use it, but again, this is a concept where you use 3 different time frames to take your trade. Okay, now I have identified 3 trades. One is a positional trade, one is a swing trade, and one is a intraday trade. So what do you mean by intraday trade? When you hold your position for maybe few minutes to few hours, right? That is what we call intraday trading. Swing trading is a few hours, maybe more than a day or two. This is what we call swing trade. And what is a positional trade? Few days to weeks. That is what is called positional trade. Okay. Now let's start from the bottom. Intraday trading. Now I have using 3 time frames. One is a higher time frame, one is an intermediate time frame, and one is a trading time frame. Please remember that you always trade in the trading time frame. You always take your trade on the trading time frame. Okay. Now it could be, again, it is a little bit subjective also. Instead of 5 minutes, some people might take it 15 minutes. Okay. Instead of 15 minutes, they might take 90 minutes, right? And here somebody might take 280 minutes as well. 280 minutes.
And instead of 5 minutes, people like me takes 3 minutes also.
It is absolutely subjective.
It completely depends on the person.
Absolutely. It is purely subjective. Okay. So here, this is a time frame. Now, ideally, I'm not saying absolutely, ideally, the difference between the 2 time frames should be 6 times. There should be a 6 times ka. Agar it is a 15 minutes, then 15 into 6 should be the next time frame. But again, it's a thumb rule. It's not an absolute rule. Okay. And some people like me, I use this time frame, and it is perfectly fine. But ideally. Now, if you're a swing trader, 50 minutes, 60 minutes, and daily time frame. If you're a positional trader, your lowest time frame, trading time frame is 60 minutes. Matlab, in the 60-minute time frame, you are going to execute your trade. Your intermediate time frame is daily time frame, and your largest, bigger time frame is a weekly or a monthly. In this case, there could be a monthly as well. Okay, monthly time frame. So this is a three time frame. Please remember, always use 3 time frame. When you set your screen for trading, let me quickly how to set your trading screen, white screen. Let me go to. So this is your computer screen. If this is your computer trading screen, now if these all the stocks prices are here, so there should be 3 time frame. I put it this way. This is 1 time frame. This is another time frame, right? So this is my 3rd time frame. So at a given point of time, the moment I click one stock, all the 3 chart changes simultaneously. So I get a snapshot view of a stock in a trading time frame, intermediate time frame, and the largest time frame in one shot, right? This is how you can place your trading screen. Now, if you See, as a trader, intraday trader, you cannot trade, you cannot trade 2, 3, 4, 5, too many stocks. So many people, what they do is that they go for multiple screen. They have got 2, 3 computer screens. So if you want to, you can set another screen here. You can set another screen here, Now here, the second screen this is your primary screen, the stock which you are trading right now. This is right in your front. And the stocks which you are monitoring, it could be in here. Okay, there in this screen, you can follow again 2 stocks, in this side again, and this side again, 2 more stocks. So you are keeping track, and in these stocks, you are largest in these stocks, all large time frames. So I have got 9 stocks here. So total 1, 2, 3, 9 stocks I am tracking here. Now here 2 stocks which I'm about to take my trade, right? And this is the stock which I'm in the trade right now. Okay. This is a multiple time frame concept, and how you can set your computer. Again, trading is a very high intensity kind of a task. Like you have to give time. You have to really put in your work if you're a trader. It's not that I don't want to watch the market and I still want to be a trader. It cannot happen. You have to give your time. Okay. Of course, sometimes nowadays lots of things have come. Algorithms have come. That helps, of course. Automated your system. That helps a lot. So you can take some time out, but more or less you should be around the screen all the time. Right now, let's go to a technical indicator called MACD. That is called moving average convergence divergence. I'm not going to get into complete nitty-gritty of MACD. I'm sure many of you already know how the whole indicator is devised. I'm not going to talk about that. Now, see, this is what is called MACD indicator. This is the price. Let me again bring my. This is what is the price, and this is the MACD indicator. Okay. See, there are 2 lines here in the MACD, or moving average convergence divergence. This is called the MACD line. The black line is called the MACD line. And this red line is called a trigger line. Okay. Now this is called a 0 line. Can you see that? And it oscillates between, above and below 0. And this is what is called an indicator. It's a simple MACD indicator. Now, can you see that the price starts going up?
Yes.
So MACD. Now, if you look at the MACD has given you buy signal right here, somewhere here. Okay, MACD has given you a buy signal. So this is what is called crossover. So this is the buy. This is the MACD buy signal. And when the MACD crosses the 0 line, this is a confirmation. Okay, so buy trigger is generated at this point of time. But the moment MACD crosses the 0 line, that is a confirmation that yes, the trend is now up. You should buy. Now,
Neeraj, how would you like to? Can you show the histogram? What does the histogram?
I'm not going to explain histogram at this point of time, Shankar.
Okay.
Now, this is what is a MACD line. Now, why it is called moving average MACD? Because there are 2 moving averages that we basically use. One is called short-term moving average. That is a 12-period moving average, and one is a 26-period moving average. Okay, see both the lines. 12 period is this, and 26 period is this. Okay, these are the 2 exponential moving average. Now, when the price momentum is very high, can you see that the gap between both the moving averages are increasing? It means divergence. So higher the gap, the steeper the MACD line goes up, faster it goes up, right? Now look at this here. The gap between them started slowing down, started reducing. Okay. Now the gap started falling now. This is where the gap is constant. At this point of time, gap is constant. That is why you have seen the MACD line is plateauing or flattening out. And then the difference between the MACD, both the moving average line is falling. Can you see that? Now the gap was more here, the gap is less here, gap is less here, gap is less here. So this is where you see the MACD is falling now. right? And now, when the short-term moving average crosses the long-term moving average, then the MACD line will cross the zero line. Okay. Now, since that did not happen, the MACD also did not cross the zero line. Can you see that? Again,
Yes.
the price started moving. So this is one. This is how the whole indicator divides. Now,
So
why?
Neeraj, you are saying that if the MACD crosses first and then starts moving up and has momentum, then there will be divergence between the two lines.
Exactly.
And when it starts flattening down, or at a particular zone where it is flattening down, it will slowly and steadily start becoming, the divergence will reduce.
Yes, the divergence is when the price is flattening out or price started moving sideways, or then this divergence has reduced. And finally, when the short-term moving average crosses the long-term moving average, and that is when the MACD will cross the zero line. Okay.
So that has not happened. That means it's still not a.
It is not still not a. It is
not a
the sale
confirmed
was
sale.
here. The sale got generated here. Yeah,
But
is
it's not taking up momentum.
Absolutely.
Okay.
Okay. Now this is the basic concept. Okay. Now there is another thing that you can use is, of course, positive and negative divergence. And what is a positive and negative divergence? This is where. See, this is again what I'm trying to do is that I'm mixing demand zone with a MACD. Okay. Now, see, this is a demand zone. Can you see this is a demand zone? This is a drop. This is a base, and this is a rally. Okay. This is a demand zone. Right now. So we have marked the demand zone, right? Now, price has come and touched the demand zone. So as per our pure demand zone, supply zone theory, we should at this point. This is the advantage of purely following pure demand and supply zone. I could have gone long, you could have gone long right at this point. Okay? Okay. Now the next moment, what happened? I got the confirmation from the MACD as well. So this is my decision support tool. Now the decision making was done here, and that decision is being supported by MACD at this point of time. So this is what I'm calling a decision support tool. It means yes, no, absolutely, I should go for a long trade at this point of time. Now, if you look another thing, there's a divergence as well. There's a positive divergence. See, the price was coming down, and MACD was bottoming out substantially at a higher level than previous low. So there's a slight positive divergence, but at the same time, the MACD has given you a buy signal right at the time when the price came and touched the demand zone. So this is how you use MACD, moving average convergence divergence, with demand zone and supply zone. Now look at this example. This is again supply zone. This is a supply zone. Price came, touched the supply zone, right? This is where the price was touching the supply zone. So instead of entering my trade right at this point, what I did is that I wait for confirmation. And I got my confirmation here. Can you see that? This is the point when I get. So it means I am going to go short in this candle. Can you see that? In the next candle of my confirmation, the first candle, this is the candle I got my confirmation. And this is the candle where I went short. And then this is what I have got. So why I'm using indicators is basically support my decision that I want to go short in that supply zone. So do my other technical tools support the decision or not? So if they support, I have got a better probability of success. And that is why I went short right here. Okay. So this is how we use MACD. So I'm not going to go much into details. Now the RSI, another tool is called Relative Strength Index. That is also same thing. Now,
before we move to RSI, I would like to compliment Neeraj that the way you explained the use of MACD at the demand and supply zone, somewhere for a beginner who is like looking at demand and supply zone, doesn't know what should be done, at least rely on the indicators and get that indicator that, nay, yes, this is something which I studied. The indicators are supporting me.
I know why we started using, it is absolutely psychological. You know why it is psychological? Let me tell you. Now suppose this is my supply zone. Okay, this is my supply zone. This is my very powerful supply zone. Why it is psychological? Now price is shooting like a rocket, touching the supply zone. How many traders would have the courage, guts to go short at this point of time? There's a huge green candle. There's a huge green candle. After the formation of a long, huge green candle, how many traders have got the guts to go short here? No doubt. Absolutely, we should go short because the price is in a very strong supply zone. Now, what I do is that I do not go short. I wait for some time. There's another candle formed inside. There's another candle formed inside. Oh, I am now comfortable because the price has stopped shooting. It means the supply is coming. The sales are coming. That is why the next candle is not like this. Demand was there. That is why price gone up like this. But the supply is also coming at this point of time. That is why the price is not going beyond. It means supply is coming. And in the meantime, my technical indicators has also given my sell signal. So this is the right time for me to get into a trade. Now I know that yes, the momentum is building on the downside or the reversal has come. Okay, so psychologically, you feel, because when you will be trading in demand and supply, I tell you, you'll be absolutely, you'll be frozen to take your trade because price is falling so sharply and price is coming to a demand zone and you have to take your trade here. You'll be frozen. You'll not be able to take the trade. It's a long red candle. It's a long red candle. And next, what people think is that the next candle is going to be like this, another red candle. But instead of that, what happened? Price goes up. So what I do is that I just wait for the confirmation. Now, many times, what happened is that there's a other side also. You are waiting for confirmation, but the next day is equally long green candle. Yes or no? The next day could be equally long green candle. So in that case, you might miss your trade as well. So therefore, what you have to do is that is where the time frame come into the place, right? That is where the time frame, that multiple time frame analysis come into the picture. So I'm going to show you how to do that. Okay, let me erase. Now this is what is a RSI. RSI, of course, we all know that is overbought, oversold. RSI is an oscillator, and can you see that it goes up, comes down? Now RSI has got two lines. One is called 70 line and one is called 30 line. Okay, so when a RSI is below 30 line, this is what we call oversold. Oversold means, yes, the probability of price, the stock is extremely oversold. Probably, it's like a rubber. When you are stretching a rubber, you have already stretched it enough. The probability of stretching it further is less. Okay, so this is what we call extreme oversold. Now it does not mean that you cannot stretch it further. You can still stretch it further. But yes, this is one of the indicator that the stock is oversold. So when the price is above 70 line, 70, it is what we call overbought. Okay, this is a simple reading. Now, of course, there are something called divergence, convergence, that positive divergence, negative divergence that you have to look for. That we'll look at it. Now, where is the buy signal? The buy signal is when the RSI is falling. It went below the 30 point and then it crosses over the 30 line. That is where the buy signal is generated. Okay, that is, for me, this is where is the buy. Now, this is where the RSI has gone above 70. Above 70, it is above 70. And this is the point where it crosses below 70. This is where my sell signal is being generated. Okay. Now, this is a demand zone. Again, this is a demand zone. So price is falling, the stock is falling, stock is falling, RSI is falling, RSI is falling, RSI is falling. RSI went below 30 and price came to the demand zone. And at the same time, RSI crossed above 30 at this point of time, right? And this is where I entered into my long trade. This is how I use RSI in conjunction with demand zone. Now, similarly, this is a supply zone. Now, look, the price is in the supply zone for quite some time, right? Price is in the supply zone for quite some time. RSI is above 70. Now, finally, here at this point, RSI has crossed below 70. And this is where my sell signal got triggered. Okay, so here the whole idea is that these conventional technical indicators are decision support tool. It helps you to take the decision, but it tells you the decision that you are taking, how strong the decision is, or how probability is in your favor, right? So this is the two consumption. Now, third, another thing that I would like to show you. I've got a very quick. Of course, I was not planning to show you right now, but I would like to show you because this is a very important concept. And it will be a lovely concept, guys. We have already seen MACD. Sorry. MACD and RSI. We have seen MACD. Okay. MACD. CD. We have seen MACD and we have seen RSI. Okay. How it can be used in conjunction with demand and supply. Now we are going to see Bollinger Band. Okay. Now, what is a Bollinger Band? Now, this is a very important tool. If I have to take you to my chart, let me show you. Okay, this is where I'll remove this. Can you all see my chart? I will just put a indicator, Bollinger Band. This is Bollinger Band. Let me remove it. Can you all see that Bollinger Band? Now, see, can you see that? Now, this Bollinger Band, now, if I, again, let me put it again. If you go to the indicator here and type Bollinger Band, this Bollinger Band is going to come. Now, this Bollinger Band has got a band. Can you see there are two lines? One is an upper line and one is a lower line. And there's a middle line. So this is a 20 period. Can you see that? This is a 20 period moving average. This is a simple moving average of 20 period, right? This is a simple moving average of 20 period. Now, why it is a 20 period? Because in a month, there are approximately 20 trading days. So there are 20 period moving average that we take. Okay, so this is a 20 period. This particular line is a 20 period moving average. Now, what is the standard deviation? This is a 2 standard deviation. Remember that. This is a 2 standard deviation. Okay. Now, let's come to the theory. Now, what do you mean by? Okay, let's come to that. Now let's come to the theory. Okay, let me open the white screen. White screen. Okay. Now, in statistics, when you study statistics, there is something called normal distribution. I'm sure you might have read normal distribution. And in a normal distribution, we have got something called bell-shaped curve. So when you have got data, and when you plot the data in a graph paper, you get something called a normal distribution. Okay, line is not coming. Okay, oh, this is how. This is what is called normal distribution. It is called bell curve. Okay, this is how the bell curve looks like. This is bell curve. Now, this is what is called the mean of the bell curve. This is the midpoint. This is what is called the mean. Can you see that?
Yes, yes.
Right? This is what is called mean. Sorry, my yes. Line is not perfect because I'm trying to draw it with the mouse. This is how the bell curve approximately looks like. And the mean, this is what is called the mean. Okay. So now we have taken a 20 period mean. Okay. Now in a normal distribution, there is 2 mean plus 1 standard deviation. Every data has got dispersion. There is something called dispersion, variability of the data. Okay. Now this variability is measured with the help of standard deviation. Okay. So when you add 1 standard deviation to the mean, right? This is a range, approx say plus 1 standard deviation and minus 1 standard deviation. If you minus one standard deviation from the mean, you will get this point. If you add one standard deviation with the mean, you will get this point. Right? So as per the normal distribution theory, what is the probability that data is going to be within plus minus one standard deviation of the mean? It is 68%. Right? It is what is the normal distribution says. Now, if you add two standard deviation to the mean, and if you deduct two standard deviation from the mean, you will get this point. And if you add two standard deviation to the mean, you will get this point. So what is the probability that your data is going to be within plus minus two standard deviation of the mean? It is 95%. Right? And then you can add three standard deviation and deduct three standard deviation as well. That is too much. Now, what Bollinger Band says, because Bollinger Band this is a 20 period moving average, and they have added the two lines with the two standard deviation. Can you see that? Let me go. See, these are the two lines. This line is two standard deviation plus mean.
Neeraj, we can on the screen we can see RSI right now.
No. Okay, let me stop share and okay, just a sec, huh?
We saw your drawing right now, the bell curve which you had shown us.
But my screen is not refreshing, right?
No, your screen I can see the RSI.
No, I'm in the Bollinger Band actually.
Okay.
I think my screen is not refreshing. Can you see now?
It's still showing the Bollinger a technical indicator RSI.
Now? No, not in the screen. Okay, sorry. I need to share just a sec. Huh? I need to share just a sec.
Don't worry, I'm looking at your presentation so eagerly.
Okay, ठीक है. Okay. ठीक है.
It's still not shared. Why don't you unshare your screen and again share back?
I will stop sharing and share it again.
Yes. Stop sharing and share your full window.
Screen.
Again share full screen.
Can you see it now?
Yes. Now it's clear.
Okay. Good. I was here only.
Yes.
So now this is how the Bollinger Band looks like. Okay. So it has got this is a 20 period moving average, and this is plus 2 standard deviation, and this is minus 2 standard deviation.
Can you just show how you plotted it? Yes.
Okay. So how to plot it? I'll just remove it. Okay, just a second. Okay. So just a second. Now to plot it, what I'm going to do is that I'm going to go to indicator. I'm going to type Bollinger Bands, right? Now see here, I'm choosing 20 period. You can change the period as well if you want to put it 30, but ideally 20 is default. That is a 2 standard deviation, right? Default. I can put 3 also in extreme situation, right? In an extreme situation, you can put 3 standard deviation as well, and then you sit down. So this is how you put it. So this is a 20 period moving average, simple moving average. And this is a 2 standard deviation, moving average plus 2 standard deviation, moving average minus 2 standard deviation. Now, you will see that when the price moves absolutely sideways, the band narrows. Can you see that? This portion band is very narrow. And look at this portion. The band is widened like anything. It's like a river Brahmaputra. At some point of time, it's so wide. At some point of time, it's so narrow, right? This is where the narrowest portion is a place where the bridges are being built. So, can you see when the price is shooting, it's expanding. The volatility has suddenly gone up. The stock's movement has gone up, and that is why it is wide. Okay. Now,
Neeraj, one request to you. Yeah. Can you also add MACD RSI with this?
I think it will make. No, I will only explain in the context of Bollinger Band at this point of time, and later they can put it by default because that will too much of a hodgepodge at this point of time. Okay,
right.
So let's do one by one. Then they integrate all the things together.
Great.
Okay. Okay, now this is where I was in a white screen. My white screen also gone. So when the price moves to the extreme, let's come to when the price has already gone beyond. Can you see this? The price has already gone beyond the 2 standard deviation, or where the price is already at the 2 standard deviation, or price has already come to 2 standard deviation line. The probability of going further is less. Now, at this point of time, if there is a demand zone, so suppose the price is coming to a demand zone here. This is where the demand zone is. Let's say, my platform is not working. Anyway,
It's connectivity.
Yeah, I'm not being able to. Just a sec. ओके कोई प्रॉब्लम नहीं, कोई बात नहीं है, मैं उसको एक यहाँ पे व्हाइट स्क्रीन में दिखा देता हूँ. व्हाइट स्क्रीन में दिखा देता हूँ, ठीक है. नाउ सपोज दिस इज माय डिमांड जोन. This is my demand zone. Now the price is coming, and it touched my demand zone. Now the Bollinger Band could also be like this, right? Suppose this is a Bollinger Band. Okay, I don't know how. Okay, this is a Bollinger. I'm just giving a hint.
It looks like this only. Don't worry. It looks like
the Bollinger Band. Now suppose this is a Bollinger Band. Okay, this is a Bollinger Band. Now the price is gone beyond the minus the lower band. Prices cross the lower band, but at the same time there's a demand zone. Can you see that?
Yes.
So the price touching the demand zone already telling you that it is a time to buy. And when the prices cross beyond the 2 standard deviation, it means the probability is very high that the price is going to mean reverse now.
Okay.
This is what is called mean reversal. So immediate target is going to be the mean.
The mean is 20 days moving average, right?
Yes, 20 days moving average. That's initial. But again, the next supply zone. But I'm purely using the context of Bollinger Band. Okay.
Yeah.
This is how you can use Bollinger Band with a demand and supply. Okay, there are 3 things. Then RSI, I have shown you RSI, MACD, and Bollinger Band with a demand and supply zone. Now, very quickly, I'm going to go into the whole decision-making matrix. Okay, what is a trading system now? Let's come to the point called trading system. What is your trading system now? Now, again, I'm coming back to the multiple time frame analysis, because as a trader, you will have to look at 3 different time frames you have to refer to. I'm coming back to that screen. Actually, this is the same slide I'm repeating again so that you still remember now what I'm going to talk about. Okay, now this is a 60-minute time frame. Now let's come. This is again. This is what is a 3 time frames. Okay, decision making matrix. 60 minutes, 15 minutes, and 5 minutes. Your trading time frame is 5 minutes. Your intermediate time frame is 15 minutes, and bigger time frame is 60 minutes. Okay, these are the 3 time frames. So first, what you have to do is you have to mark your demand and supply zone in a 60-minute chart. Your homework will start from 60 minutes. आपका जो homework है, when you look at a chart, your homework or preparation for the trade is going to start from the 60-minute chart. So open your 60-minute chart, mark your demand and supply zone. Now there is another concept called curving, which we don't have time today, but I think I'm going to explain it next time. That is called curving. So what do you mean by curving? Now this is my supply zone, extreme supply zone. This is my extreme demand zone in a 60 minutes time frame, higher time frame. Okay. So where is the price relative to my supply zone and demand zone? If the price is closer to my demand zone, we call it down in the curve. If the price is closer to my supply zone, I will say up in the curve. And now, if the price is somewhere in the middle, we'll call neither up in the curve, in the middle area. Okay, in the middle of the curve. This is what is called curving technique. This is a up in the curve, extreme up in the curve, up in the curve. This is a down in the curve. Now, if the price is down in the curve, I need to look for buying opportunity in a intraday. If the price is up in the curve, extreme up in the curve in the supply zone, I will look for selling opportunity. I hope this point is clear, Shankar.
Yes, clear.
Right? So this is in the 60-minute time frame, not in the trading time frame. Trading time frame is 5 minutes. I'm talking about the larger time frame.
So the larger time frames will help us decide on the demand and the supply zones.
Exactly.
While the
larger
60-minute
time frame. Sorry.
The larger. That's the 60 minutes time frame, and the shorter time frame we will be putting our trades.
Exactly. The larger time frame is going to help us filtering possible trades for today. When I do my homework for tomorrow, I'll probably go through 60-minute chart of 50 stocks, and out of 50 stocks, probably I have found 7 to 8 stocks who are up in the curve or down in the curve. So, okay.
Can I ask you a personal question, Neeraj? How do you select those stocks? I mean, as an audience, I'm asking, and I'm sure this question would have.
I will come.
Please add that part.
That is
some easy ways of how to select the stocks.
Of course, to select the stocks, of course, one of the very important thing is the volume. Trading volume has to be very high. It has to be a liquid stock. So ideally, for trading, confine yourself to Nifty 50 stocks or Nifty 100 stocks. But again, see to it that minimum volume should be, a few lakhs. It should be, we have got crores of shares being transacted in the top stocks. These are good. So ideally, you need to choose a stocks whose liquidity impact cost is very less, liquidity is very high, and I think Nifty 50 is the best stocks to trade intraday.
And I think covered any of the dashboards of like I check out in Paytm Money, so our dashboard does show the top 50 stocks.
Absolutely.
And even in derivatives, we can do that.
Exactly.
Okay. So volume, check the volume and pick up those 10 stocks.
The volume is only for stock selection, Shankar.
Stock selection, yes.
Yes, not for, again, remember what Sam have said. Volume is not a part of our demand and supply. Okay. But again, you can look at it, but again, it's a secondary, very secondary. It's insignificant. Okay. So in the 60 minutes, mark your demand and supply zone. Okay, that's the first step. Second step, if in the demand area, look for long trade. If in the supply area, look for short trade. We understood that point. Right? Now, if
clearly.
In the demand...
Clearly.
Yes, we understood that point. Now, there might be a third situation where the price is in between the demand and supply. That is in the middle between the demand and supply. Clear? So there are three possibilities. Either the price is in the demand zone or in the supply zone or somewhere in the middle. So 1, 2, and 3 possibility. Now, if the price is directly in the demand zone or a supply zone, I will bypass the intermediate time frame. Because it's already buy, right? It's in the demand zone. It's in the supply zone. It's already buy. So I will straight away go to the 5 minutes time frame, the lowest time frame. And the moment I get a buy signal in MACD, RSI, or super trend, I'm going to buy. Right? I can put the stop loss, my demand zone below the demand zone, or I can put the stop loss below the super trend as well. Okay, these are the two things that I'm going to do. So if the price is in the 60 minutes time frame in the demand or supply zone, I will bypass the intermediate time frame and go straight to 5 minutes time frame and initiate a trade. Because I just need a confirmation in my lowest time frame that the price is going to reverse, and that's why I'm going to take. Now, the complication arises when the price is in the middle of the demand and supply. That is where the complication is. Okay. So in that case, what am I going to do is that I'm going to use 15 minutes time frame. Now, what am I going to do? I'm going to look for a trend. What is the trend in the 15 minutes time frame? Because the price is in the middle of the demand and supply zone. If the trend in the 15 minutes is up, then I'm going to look for a long opportunity. If the trend in the 15 minutes time frame is down, I'm going to go for a short opportunity.
So in that case, Neeraj, we don't look at the demand and supply zone of the 60 minutes period.
No, because anyway, the demand and supply zone is far away from the current price. Demand zone is here, supply zone is here. It's anyway far away. Shankar, you are mute.
Like you said, like it's somewhere in between the value zone and from where it's turning around and going back to the demand zone or supply zone.
See, currently this is my demand zone, this is my supply zone. It is already far away from the demand and supply zone.
Yes.
In the 60-minute chart. So therefore, what am I going to do is, again, this is a pure indicator trading, indicator plus demand and supply zone. So I'm going to use 15 minutes time frame for my trend. If the stock is in the uptrend, 15 minutes time frame, then I'm going to use 5 minutes time frame for my entry and exit. Okay, I hope this point matrix is absolutely clear.
Clear.
Now I'm going to go for again entry stop loss target in the 5 minutes time frame, because your entry is always in the 5 minutes time frame for an intraday trader. Okay. Now for a swing trader, of course, it could be 15 minutes or 30 minutes. For a positional trader, it could be 60 minutes. Right? Now your entry is always in the lowest time frame. In case of intraday, it is 5 minutes time frame. Okay. So what is your entry? Of course, when the buy MACD RSI, stop loss, where the stop loss? Super trend, right? And what is the target? Corresponding supply zone. That is one target. Sell signal in any of the indicator. If at 5 minutes I bought, because I'm an intraday trader, I do not have so much of, I just want to take my profit and get out. For the next trade, I will see afterwards. But at this point of time, the moment I get my profit and I get my sell signal in RSI or MACD, that is the time that I'm going to take my money and move out of the market. Okay. Or third, you can always fix a percentage. Okay, 2% today, I'm out. 3%, I'm out.
So right? In stocks, 2%, 3%.
These are different ways of fixing the target. One way, one condition is the supply area में आप exit कर सकते हो. Second condition is that आप जब सेल सिग्नल इंडिकेटर दे देते हैं आप एग्जिट कर लो. थर्ड कंडीशन इज दैट अगर आपको ये भी कोई सेल, आपका सप्लाई एरिया बहुत दूर है लेकिन आपका इंडिकेटर भी आपको सेल सिग्नल नहीं दे रहा है, देन आपको 3-4% अचीव हो गया है, चलो पैसा लेके निकल जाओ, है ना. Price not moving for a long time. The third is again price is not moving for a long time. Time stop loss. Get out. Right? So these are my exit targets. Okay.
Neeraj, one more question.
Yeah.
How do we keep stop loss using the super trend?
Okay, just below the super trend. Can you see my again? Let me share my screen again.
Yeah.
Oh, it is not coming. Sorry.
Because it's a miss. Can you just click on this? Yeah, refresh. It will come. Change to Nifty, I think. Today is Saturday. So generally...
Yeah, I think all the...
On the right side, can you see Nifty? On the right side?
Okay, no problem. कोई बात नहीं, Nifty Pharma है, but we just need to show, है ना? There is no problem. Super trend. This is where you have to type super trend. Done. Can you see that? Now,
so do we keep the default one?
This is the same one. This is a default super trend. We are going to use default super trend only. Can you see that? This is where आपका super trend, this is how the stop loss. See, you get the whole rally from here to here. Right? And this is where the price came to the supply zone. Can you see the supply zone, guys? Where the price is reversed from? Just a sec. Oh, sorry. Can you see the supply zone, guys? This is a supply zone. Can you see that?
Yes.
Rally base drop. Price came to the supply zone. Yes or no? So this is where is your exit. Now you can exit right at the supply zone, because anyway, this is ultimate your target. Supply zone is the ultimate target.
Okay.
When the price comes to the supply zone, as a trader, my ultimate target is the corresponding supply zone. Get out. So if you are not getting out, so in between, if the price start reversing, see how this is what is a trailing stop loss by using super trend. Can you see this line? This is where the trailing stop loss by using the super trend. It is not been broken, and after here supply zone, it came down and it broken. Now this is where in the short side. Okay, so you can use that as well. Super trend for the stop loss, right?
That was amazing, Neeraj.
Super trend for the stop loss, you can use it. And this is how, of course, let me tell you, it needs practice. You have to you have to really go through. You have to set up your screen. You have to observe the market for quite some time. Paper trade, take your paper and start trading. And once you develop the skill, once you are absolute, and again, let me tell you one more very important thing. It is not necessary that you use all the three indicators. We discuss about Bollinger Band, we discuss about MACD, we discuss about RSI. It's not necessary. One indicator is enough. You can use Bollinger Band or you can use MACD. One indicator. That is enough for you, right? With the demand and supply. So with that, Shankar, I have come to an end of this program today, presentation. I hope participants liked it.
Participants liked it. I loved it. But my question is, like always, all the participants keeps asking at least at one time in the chat. So I'm just repeating one of the questions which they generally ask in the chat. So Neeraj, I could not take notes. So will I be getting a video copy of this?
Yeah, I think
as a participant I'm asking. We'll be sharing
the screen. We'll be sharing the video recording. Also, we'll be sharing the presentation which I have shown to you. And so, don't worry if you are confused in between. You will be getting that PPT. So use it. So
I always get this question, this doubt keeps on coming up from the audience from time to time. So and thank you, Neeraj, for clarifying. I think you simplified the demand and supply theory, and what I liked best, Sam gave us the concept, and you put in that Indian tadka in it and the masala. By putting in the directional indicators, now we have got the demand and supply clear with the masala of your indicators of MACD, RSI, Bollinger Band, as well as your super trend. So you shared 4 indicators. Amazing.
See, Sam is
so now let me be proud and tell you that there are 2 winners who actually scored the will.
Congratulations to both the winners.
So that's the case. And now we actually have 2 winners for this. So one of the winners is let's name. I just got the name. Shiva Kumar and Pratik K are the winners. So Shiva Kumar and Pratik K.
Congratulations, Pratik.
They're 2 winners. What to do now? As we shared, we got to spin the wheel and now get the lucky draw done. That who is going to get the best speaker? The speaker. So host, can you just wheel is being spinned. Is it Pratik or Shiva? Pratik! Wow, great. Amazing. Congratulations, Pratik.
But at the same time, congratulations to Shiv Kumar as well.
Because he gets the Marshall speakers. And congratulations to all of you. And Shiva, you also won. But congratulations to all of you for the knowledge which you have got. And you all are going to be the winners if you get to implement them. You know the demand and supply story, and we've polished it by using the indicators. We went through the previous class where we learned about the introduction to demand and supply. Then we learned about price action theory. Then today we got demand and supply, how you initiate the trades, and Neeraj polishing it up today with the directional indicators for your support. Yes, you can be the real winners of the market. Implement the knowledge, keep practicing, and keep sharpening your saw. So, thank you very much, and have a great week.